All central banks are actively engaging in stimulus measures in response to the growing crisis which has emerged on top of the global economic slowdown. Now they have their perfect excuse. The problem here is that they've been stimulating the markets for 10 years. They're exhausted. They need a break, but they won't get it. More intervention will occur, of course, because this is the name of the game. Inject fiat currency into a system, buy assets of all kinds, and displace real individuals. Inflate the currency away and put further and further control into the hands of the few. Success. You came here for the truth, so let me unveil that for you. Today we're going to look at what the central banks are doing. I'm going to show you the ECB, the BOJ, the Federal Reserve. We're going to talk about what the Treasury is doing. We're going to look at what's happening with the economy. If you stay with me in this entire video, I'm going to give you the ins and outs that you need to know. If you leave, well, check out CNBC. I'm sure they've got the full picture for you. Let's begin by taking a look at the markets themselves. They rocketed higher, 1,300 points in one single day. This was insane, and I believe it was the most in terms of points that has ever been seen by far. 1,300, and particularly towards the end of the day. Now, we can speculate on what that was. Maybe it was the PPT, the plunge protection team. Maybe it was hedge funds and other things repositioning. Regardless, the Dow Jones went up 5% in a day. Now, it had been coming down significantly. If I look at this over the last 5 days, if it'll show me a chart here, you can see what has happened. It's still down from its high, there's no doubt, but the S&P, for instance, has come back above 3,000, and the Dow Jones potentially, we'll see what happens here, could start to inch its way towards 27,000 and continue onward and upward. The Nasdaq, of course, goes up because everybody wants to buy their 7 shares of Amazon. Look at the Dow Jones daily percentage change. We have never seen it this high since the introduction of QE1. So imagine, this is it. We've just had the financial crisis. Everything's in chaos. Federal Reserve comes up and says, we're going to do this thing. It's called quantitative easing. We're going to print a whole bunch of money and buy up the assets. The worst of all that, don't worry about it. We're going to cover you. Then stocks go up like crazy as a result. The same response occurred to what just happened today. Now, that huge news that we had, right? I mean, it's massive. I mean, this news, well, I tried to find the news, but it wasn't there. So what was it exactly? Well, they'll act as appropriate. We've seen this all before. We know what it means, but they're using their Fed speak. They're using their convoluted messages. Essentially, the Federal Reserve is going to lower interest rates. The only question is, will it come at the meeting or will it even be before that? I think it depends on how the market's reacting up until that moment in the coming days. They could certainly do this, expand on their repos. They could expand on quantitative easing 4, or they could do something else altogether. I do expect that they'll cut rates. I'm not sure if they're necessarily going to expand on their different programs that they have, but surely they can keep that beyond April, as they've already mentioned that they might do. Take a look at this here. Jim Bear Stearns Kramer. I thought it was funny. Always trying to bring you as much humor as possible. I think the facts and the concomitant reversal of interest rates from the ridiculous lows that they allowed, that's what allowed the market to roar today. This is funny because you always hear about what the Federal Reserve allowed. It isn't a free market at all, and they don't even try to sugarcoat it anymore. The Federal Reserve has to be there. The central planners have to be there to maintain everything. In 2008, that never should have happened because the Federal Reserve should have been there to save the day. Even though they caused the problem along with their friends, it's all one unit. Don't look at the Federal Reserve and then all of these big banks as their own separate entities. Understand that they all work together on a daily basis, as well as what's going on behind the scenes. That is not crystal clear if you see it from the outside, but once you start digging in and understand how this institution was set up initially, that's going to give you some major insight as to how it all works. Global financial ministers and central bankers will hold a conference call on Tuesday to coordinate the financial and economic response to the situation that's going on today. By the time you're watching this video, this may have already happened, and we'll have none other than Mr. Munchkin as well as Jerome Powell to be there leading the whole ordeal. This should be pretty funny. Really quickly, Larry Kudlow and the Munchkin both favor the Fed cutting interest rates before the next scheduled meeting, March 17th and 18th. This is actually favored more so than trying to cut taxes, than trying to use fiscal stimulus. I really don't understand at this point still why this actually has such a major impact when the interest rates are already so historically low, but this is the world we live in. This is from the IMF's own website, and the IMF and the World Bank together made this statement suggesting they will get in on the action if necessary. Quote, "We will use our available instruments to the fullest extent possible." Check this out, including emergency financing, policy advice, and technical assistance. Maybe, just maybe, we're going to see the SDR make its appearance in 2020. We have noted many times before with the IMF handing out a bunch of cash in bailouts, whether it's Argentina, $50 billion completely wiped off, erased from existence basically, partly your tax dollars, just to be clear about that. SDR is going all over the place, but in this case here, we may see it becoming more prevalent, and I will cover that information for you as it comes out. We have the Bank of Japan that's ready and willing to act, and they are going forward with it. Bank of Japan's Kuroda vows to maintain market stability in statement. He issued an emergency statement following a week of turmoil in markets over the economic implications and said this: "Will strive to provide ample liquidity and ensure stability in financial markets through appropriate market operations and asset purchases." I believe in the previous video I did cover that. Here's some detail. The BOJ quickly showed what kind of action it would take by offering to buy 500 billion yen, that's $4.6, of government bonds with a repurchase agreement to provide liquidity to market participants. And then right here you could see in the chart, the BOJ buys 100 billion yen in equity ETFs. Of course, this devalues the currency, and you can see what happened to the markets as a result. They love it. This chart here just shows you the ETFs in Japan, and it's unbelievable because I've seen all kinds of different numbers, but the number I keep seeing over and over again is 80%. Imagine this. The central bank and the government of Japan own 80% of the ETFs in the country. There are no real investors left in Japan. This is what's not understood by the general public, the investors, the people who put other people's money at risk. It's a fraud. It is an absolute fraud. And yet it persists because you're willing to accept it. But there will be a day when investors simply can't anymore. And then we will know why central banks are a failure. Echoing the BOJ and the Fed, a senior official at the ECB said that they could take its interest rates further into negative territory and begin new bond purchases to support the Eurozone economy. This has been a problem for years and years and years. They never resolved it. And now they've got the perfect excuse. Well, we had to do something because this issue was having an impact on everywhere. It's not just us. It's not just our country. No. We are going to have to act. We'll all act together. And this is basically what they're all saying. That's what I'm sure this conference is going to be all about. They're going to go out there and they're going to say, look, we're going to act as appropriate to sustain the expansion. We're going to lower our interest rates. We're going to print money and we're going to devalue the currency so that people get screwed over. We're not going to fix any of the underlying issues. We're not going to actually try to generate growth here. We're not going to even try and fix the problem. We're just going to print, and print. This is Kelly Evans from CNBC. I thought it was funny because they always have the perfect resolution to any problem. What do you think it is? Check this out. You can say the US doesn't have room for more spending since we're already running a large deficit, but we really won't have room if the economy tanks in the future, and neither the Fed nor the government can do too much to help. A little spending now to help people and businesses deal with the situation and to make sure the business cycle keeps going is far better than huge spending later on, along with major market interference from the Fed. Essentially, essentially what they're saying at this point here is pump up those deficits even more, get the stimulus happening, TARP type bailouts, whatever you gotta do to make it happen now so that we can prolong this bull market. But this is just the problem here. This bull market started in 2009. It's gotten way far beyond where anybody ever predicted. It's stretched out to this point, and the more intervention historically has always made it worse. But their jobs really do depend on central banks and their activities. This chart here just shows you a breakdown of the impact that this situation has had on each different industry. You can look at this chart if you're interested. Take a look at the yield curve inversion. It started to flip around and come back up. We'll see if this continues. It climbed really quickly at this point. And of course, the more intervention by central banks, the more they can get this to come up. It's an artificial adjustment of the yield curve, and that truly makes it difficult to determine it as a signal of recession. But we had hit that point for a while previously. We know it's simply a matter of time. The economic impact is very clear. I've got some charts, I've got this article here as well. Manufacturing activity in the US grew at a slower than expected pace last month because, of course, all around the world we are seeing that slowdown. They still kept it, they padded it nicely and kept it above 50.1. But you look at other countries around the world and you see the same thing. It's all down. I'll show you some more in a second. Global manufacturing suffers steepest downturn since 2009. That's big, that's huge. Take a look at these charts. JP Morgan Global Manufacturing PMI. Global manufacturing suffers the steepest contraction in over a decade. It hits the supply chains and demand that is clearly present right now. We have not seen something like this in such a long time. Look at what has occurred. You could see that on both of these charts. The top one being the JP Morgan Global Manufacturing PMI. Right now, 47.2. Of course, anything below that 50 mark means it's a contraction. The chart at the bottom, PMI by goods sector, consumer, intermediate, and investment, all down, down, and down. Take a look at the chart on the top left corner, PMI Manufacturing Output Index, and you could see how this has declined. It looks like around 44 on this particular chart. We have seen so many different statistics appearing underneath that 50 mark, and it's been going on for quite some time, as I consistently mention over and over again. From 2018 up until the present, so many things have been trending downward. On the other hand, stocks have largely been trending upward. This is a huge disconnect, and it is really bad because eventually everything must revert to the mean. On the right hand side, this chart just shows you the manufacturing PMI, different countries. If you're interested, you could take a look at which maybe you're from or you're just interested. This chart gives you a big list. Here we're just looking at the global manufacturing output. The teal color one is the PMI output index, and the orange line is the official production data. This is the global manufacturing lead times and inventories falling off a cliff for both of these here. This is the global manufacturing output. You're comparing the manufacturing PMI global excluding China, and China as well. All of these are not looking good at this time. And then this is the chart relating to the US PMIs. Not good. It's moving towards contraction territory once again. I'm going to end the video there. If you found it informative, hit that thumbs up button. About 10% of people actually do appreciate the information, and I want to thank you for being one of those people. It really does help me out a lot. If you want to learn about selling online, this course is for you. We're talking about everything that you need to know, and you don't have to pay a dime. If you want to check it out, theamazongps.com. If you want to understand the financial industry, all the ins and outs, but you don't want all that jargon and all that nonsense that they tend to teach you, these two books have everything you need. All the details are located in the link in the description. If you want the audiobook instead, themoneygps.com. Do you want to know if a bear market is coming? This video here will tell you exactly that, according to one of the major banks. Click on it and I'll see you there.